This third video will examine two more important questions, namely, why should you invest in stocks and why should we be optimistic about the future? More importantly, let's consider what happened to investors in past bear markets who bailed out after a significant decline and moved their money to a safe, interest-bearing security. Let's look at the tough bear market of the 1970s to illustrate our example. This was a very gloomy period in our nation's history, and some people lost a lot of money. You really couldn't blame investors for throwing their hands up and screaming, "Get me out." But moving what is left in your portfolio to a bank account or a CD may not always be the best strategy if you want to meet your long-term goals. As you can see, a $100,000 investment dropped to under $58,000 in less than 2 years. While getting out of the market may certainly help to avoid more down days, it also means missing out on the up days when the market does bounce back. Investors who stayed invested during this difficult time would have done much better in the long run. Each period shown in this chart demonstrates a wider gap between the hypothetical safe 5% investment versus the hypothetical investment in the S&P 500. And at the end of the 10-year period that followed, the S&P 500 returned more than 2 times that of a 5% interest-bearing instrument. Remind yourself of why you invested in stocks in the first place, because stocks have been the best performing asset class over time. If we go back to our illustration of the growth of $1 since 1925, we can understand why people choose stocks as the primary investment vehicle as part of a long-term investment plan. But with everything that's going on in today's market and the steep downturn that we have experienced, is now a good time to be invested? Why can't we just sit on the sidelines, wait for things to stabilize, and then get back in? The answer is very simple. History has shown us that the market moves in rapid bursts. Let's look at the 10-year period from 1998 to 2008. The market, as represented by the S&P 500, had returned just about 6%. But if you look what happened to returns when you miss out on the best 10, 20, and 30 days, you can see the effect. This is exactly the reason why it is so important to stay invested and forget about trying to time the market. Success is measured by time in the market, not timing the market. Why should you be optimistic about the future? I can certainly understand how difficult it is to remain optimistic when the market turns negative, especially if the returns are negative for several years in a row, or as pronounced as we've seen today. The phenomenon of a 5-calendar-year period with negative returns for the S&P 500 has only occurred 10 times since 1926. 5 of those periods occurred around the stock market crash of '29 and the Great Depression. 2 of them coincided with the 73-74 bear market, and the others were during the most recent bear market. In each case, the period following a 5-year period of negative returns has indeed produced exceptional results. Look at the average annual return produced by the blue bars, which represents the 5 years after negative returns. Now, while past performance is no guarantee of future results, these down periods can often be a great buying opportunity for investors. There's also another reason to be optimistic and to stay invested in the market. Although bear markets have traditionally been short-lived, as we've seen in the previous slide, bull markets typically start with a bang and last for an average of 4.5 years. Just look at the average annual return for the 1-month, 3-month, 6-month, and 12-month periods at the start of a new bull market. Thank you very much for listening. I look forward to answering any questions you might have.